When I first got started investing, I studied the best investors in history. I wanted to find out how they managed to outperform the market and learn from their success. My hope was to be able to use the same techniques to mimic their performance. One of these investors is Warren Buffett, and if you have a desire to become rich, you should learn and understand how Warren chooses his investment. How does he pick winners year after year, and over time massively beat the market? The short and simplified answer is that he uses fundamental analysis to calculate the intrinsic or fair value of a company and buys stocks if the company is undervalued. But there are a lot of details and wisdom you should learn from Warren in order to properly calculate the fair value. In this video, we'll describe the key parts of Warren's investment philosophy so you can learn and hopefully achieve amazing returns on your investments. This is investing in a nutshell. Before we dig into how Warren Buffett picks his stock, we must start with the basics. What is fundamental analysis? Fundamental analysis is a method of evaluating the intrinsic value of a company by examining its financial and economic fundamentals. The goal is to determine what the fair value of the company is based on analyzing the company's financial statements, including its income statement, balance sheet, and cash flow statement. The analysis also includes examining the company's industry and economic outlook, its management, and its competitive position. Typically, investors look at 4 key ratios when calculating the intrinsic value of any company: the price-to-earnings ratio, the price-to-book ratio, return on equity, and debt-to-equity ratio. In short, the price-to-earnings ratio is a valuation ratio that compares a company's share price to its earnings per share. A high P/E ratio may indicate that the company is overvalued, while a low P/E ratio may suggest that it is undervalued. The price-to-book ratio is another valuation ratio that compares a company's share price to its book value per share. The book value is the total assets minus the total liabilities of a company. A low price-to-book ratio means that a fair value of the company is backed by its assets. The return on equity is a profitability ratio that measures the company's ability to generate profits from its shareholders' investments. A high ROE is a good indicator of a profitable company. The debt-to-equity ratio is a financial leverage ratio that measures the company's level of debt compared to its equity. A company with sound financials should be able to pay off all its debt using 4 years of its net profits. All these metrics are the basic and essential metrics to evaluate for any fundamental analysis. But there are a lot more to the story if you want to analyze companies like Warren Buffett. In many ways, Warren has the same basic ideas as with conventional fundamental analysis. He looks for companies with strong financials and sustainable competitive advantages. The company needs to have a solid track record of profitability, a strong brand, and a competitive position within their industry. He also seeks companies that generate strong cash flows, have low debt levels, and have a history of paying dividends. But what does this really mean? What is Warren Buffett's secret to calculating the intrinsic value? In 1996, Warren Buffett issued a booklet entitled An Owner's Manual. In this book, Warren writes, "Intrinsic value is an all-important concept that offers the only logical approach to evaluating the relative attractiveness of investments in businesses. Intrinsic value can be defined simply. It is the discounted value of the cash that can be taken out of a business during its remaining life." Still confused? So was I the first time I heard this sentence. In a nutshell, all we need to do is calculate all future cash flow using a discount factor to find the present value. We can then use this to calculate an intrinsic value. According to Buffett, it's not easy, because intrinsic value is an estimate rather than a precise figure, and it's additionally an estimate that must be changed if interest rates move or forecasts of future cash flows of the company are revised. We've studied Warren's description for how he calculates the intrinsic value and compiled this to a 7-step process. Using these steps, you can determine if a company is overvalued, fairly valued, or sells at cheap prices. Step 1. Owner's earnings. The amount of cash a business generates for its owners is what Warren Buffett refers to as owner's earnings. With the right management team, cash deployed in a business will add value and give investors the chance to sell it for more in the future. and/or generate income from dividend payments. A simplified formula for owners' earnings is to take the operating cash flow and subtract the maintenance capital expenditures. Operating cash flow is a measure of the total amount of cash generated by a company's normal business operations. Experienced investors might notice that owners' earnings is also very similar to the simple free cash flow calculation, as typically used in traditional discounted cash flow valuations. To calculate the free cash flow, you take the same operating cash flow, but subtract the total capital expenditure instead of maintenance capex. Because free cash flow considers both growth and maintenance capex to estimate the amount of cash a business can generate for its owners, it's a more conservative measure than what Warren Buffett uses. Step 2. Growth rate. There are two ways to calculate the owner's earnings for the next 5 or 10 years. Either you have a lot of experience and knowledge of the company and its plans to expand, and therefore are able to estimate the owner's earnings per year, or you can calculate a growth rate. Warren Buffett himself doesn't use a secret formula or model to estimate the growth rate. Instead, he gains a thorough understanding of the company and the industry it's in. This includes, but is not limited to, drivers of revenues and expenses, what the company is doing now to drive growth, the company's management team, consumer and industry trends, and the strength of the company's economic moat. Using this, he's able to estimate the owner's earnings for the next 5 to 10 years. The growth rate will be applied to the computed owner's earnings number for a business. This will give investors an approximation on how much cash the company can produce over the forecast growth period, which is typically 5 or 10 years. For investors who do not have this level of competence within a particular industry and/or company, the best option is to just be conservative and to focus on simple businesses that you can understand. Most likely, if you apply a conservative growth rate to your DCF calculation, your intrinsic value calculation will not be far off, especially after you apply an appropriate margin of safety, but more on that later. One way to estimate the growth rate over the next 5 or 10 years is to calculate the owner's earnings, or free cash flow growth rate, year over year, for the past 5 to 10 years. Then you'd simply take the average over this 5 or 10-year period to get an estimated growth rate that you can then apply to the intrinsic value calculation. Another option that follows the same methodology as the free cash flow growth is to instead use the average net income growth rate for the past 5 or 10 years. The problem with this is that numbers on the income statement, including net income, are typically manipulated more than numbers on the cash flow statement. However, it can still be useful in determining an appropriate growth rate for owners' earnings. Step 3. Discount rate. After you apply the estimated growth rate to the most recent owner's earnings figure over the 5-year or 10-year period, you must discount these cash flows back to the present value. This is because inflation will reduce the value of future money compared to today's value, and because of opportunity cost. In essence, $1 today is worth more than $1 in the future. But what is the appropriate discount factor? Traditionally, what is taught in finance is to use the weighted average cost of capital as the discount rate, as it's a measure of what it costs a company to acquire funding. However, this comes with many false assumptions and simplifications of reality, and the formula is also rather complex and not beginner-friendly. More importantly, it's not used by Warren Buffett. Warren Buffett uses the U.S. 10-year Treasury rate as the discount rate, which is also a lot easier for us retail investors to use. Step 4. Terminal value. Terminal value is the value of a business after the forecast growth period, for instance, 10 years. Terminal value exists because you cannot reasonably estimate cash flows forever. The preferred method for calculating the terminal value of a stock is to use the perpetuity growth method, also called the Gordon growth method. This method assumes that the cash flows after the forecast growth period will grow at a constant rate into perpetuity. The Gordon growth method is as follows, where you use the owner's earnings from the last year in your calculations, an estimated annual terminal growth rate, which is usually a conservative number, the discount rate calculated in Step 3, and the number of years used in your calculations. This will give you a present value of the terminal value. We also need to note that Warren Buffett often decides to use a zero value as the terminal value, leaving only the calculated owner's earnings for the period to be part of the intrinsic value calculations. Step 5. Calculate intrinsic value. Finally, we are at the crucial phase where we can calculate the intrinsic value. We've calculated the owner's earnings, estimated the growth rate, found an appropriate discount rate, and calculated a terminal value. To calculate the discounted free cash flow like Warren Buffett, use this formula to estimate the intrinsic value. In this formula, we'll calculate the owner's earnings from each year and use the discount factor to figure out how much that earnings are worth today. In the end, we'll add the terminal value, or 0 if you choose to assign that as the terminal value. This calculation will give you an estimate of the intrinsic value of the company. In order to find the fair share value, you need to divide the intrinsic value by the number of outstanding shares. Using the fair value for each share, you can get an initial idea of whether the company is overvalued, at a fair value, or undervalued. If the calculated intrinsic value is above the current stock price, you might have found an undervalued company and a buying opportunity. But we're not done yet. There's still 2 steps left in the process. Step 6. Scenario analysis. To adjust for possible mistakes when it comes to predicting the future, a sensitive or scenario analysis is always a recommended practice. In short, this is simply when you have different inputs for variables that can affect your discounted free cash flow valuation. In relation to Buffett's approach to the valuation, this primarily refers to the growth rate, the discount rate, and the owner's earnings calculation. Scenarios force you to think in a different way, which is why they're valuable. For example, you can have a worst-case scenario, best-case scenario, and normal-case scenario for a company, where you only alter the owner's earnings growth rate. Then you could assign probabilities to each scenario based on your understanding of the company. For instance, you may apply a 50% probability to the normal case scenario and 25% probabilities to the worst case and best case scenarios. Use the calculations individually or calculate an average intrinsic value from the different scenarios, where each of them is assigned a weight based on the probability for the particular scenario. Step 7. Margin of safety. Margin of safety is one of the most important investment valuation concepts. The term was coined by Benjamin Graham in the 1949 edition of The Intelligent Investor, where he devoted an entire chapter to this concept. Warren Buffett learned his trade from Benjamin Graham and is his most famous and successful student. Buffett described the importance of margin of safety in the following quote: "You also have to have the knowledge to enable you to make a very general estimate about the value of the underlying businesses, but you do not cut it close." That is what Ben Graham meant by having a margin of safety. You don't try and buy businesses worth $83 million for $80 million. You leave yourself an enormous margin. When you build a bridge, you insist it can carry 30,000 pounds, but you only drive 10,000-pound trucks across it. And that same principle works in investing. As Buffett explains, the margin of safety should be applied to every intrinsic value calculation, so that you can account for errors and estimates in the calculation. Moreover, a margin of safety will protect investors from uncertainties the future holds and from companies that underperform, thereby reducing an investor's downside risk. This is simply because a margin of safety will encourage you to buy a business that's worth $100 for $70, for example. In conclusion, Warren Buffett's approach to fundamental analysis has helped him become one of the most successful investors of all time. While it may seem daunting at first, by following his principles and staying patient, disciplined, and rational, you too can pick stocks like Warren Buffett by using the 7 steps described in this video. So start by learning the basics of fundamental analysis and try applying it to companies you know and are interested in. Keep up with the latest news, company reports, and market trends. Remember to focus on long-term investment goals and not short-term fluctuations. It takes time and practice to master the art of fundamental analysis, but with patience and perseverance, you can start making smart investments that will pay off in the long run. In our next video, we'll use Warren Buffett's methods to calculate the intrinsic value of Tesla Make sure to tune in on that one. We hope you've enjoyed this video and that it's inspired you to start using fundamental analysis to pick your stocks. If you have any questions or feedback, leave a comment. And if you haven't subscribed yet, make sure to do it so you don't miss out on any future content. See you in the next one.